Hi, this is David with the Enzo Trading System. Today I would like to touch again on the topic of predictability of market data, of price movement. This is something that I touched upon already in a previous video titled Are Markets Random and Unpredictable? I think this is still a valid video. It was kind of a bit on the long side and it touched kind of a few subtopics. The goal for this new video is to be somewhat more brief and also to give a slightly different perspective on things, one that could resonate with some, hopefully. So I think the first most important thing is really to ask the question, to ask a different question. That would be from the generic, are markets predictable, to the more specific, when are markets predictable? So markets, of course, they have different phases. People that often tell me that market are not predictable. It's built on the basis of markets depend on the news or the action of perhaps some very rich entities that will move the market price on a whim. So by that definition, in any case, there should be a condition by which there are indeed different phases that we can objectively divide the market, the price action between. So here I would like to divide really in two major phases, which I consider to be relevant. And one would be when there are usable trends. So if the price movement goes up and down, and it does it so taking several days, ideally, so that there's a sense of confirmation of a certain direction, and then whether one is trading with the trend or against the trend, there's still a somewhat reliable direction. And the ugly side of the markets is really when there's long stretches of lateral movement, and I define this as a stair-step type of shape, which is actually something that we've seen recently for the recent at least couple of months on Bitcoin and all the other cryptos, where there are several stretches, perhaps 1 or 2 weeks of price movement, which is by and large lateral, and then with subsequent dumps or jump on the upside. And many people think that actual market dumps are a problem, but when you're actively trading and you have stop loss, this is actually not a problem at all. Ideally, one has a short position open, so you can make a profit here. In the worst case, a stop loss will, if one has a long position open, a stop loss will be triggered and the loss is averted. But when actively trading on a lateral movement, there's the big issue that yes, the market is on average lateral, but there will be still kind of a relatively high frequency noise where there will be some undulation going up and down, and some will say you can individual range and make a profit from there, but to really establish a profitable range within which one can be profitable, I think it's easier said than done. And I will show here actually recent few days on Bitcoin and what it looks like. Here we, for example, open a short position and then the price decides to go up instead and ends up with a loss, and then open a short position, the price goes down, but then it could be quite good profit. It turns it's really a minimal profit because the price continues to bounce. And again, one could try to establish a kind of a level at which the price bounces, but it's not something that can be done consistently. It's very easy to get lost in the woods, and I think it's quite objective, the fact that lateral price movement it's the hardest phase in which to trade. And actually, I would like to quantify that a little bit more by introducing a concept of entropy. So a signal is more or less entropic depending on how the data that composes the signal, the samples that compose the signal, are ordered. If there is more order, the signal is less entropic, If there is less order, the signal is more entropic. And at the same time, if there is more order, it's more likely that now we can predict what will be the next sample. If there is less order, it's pretty much nearly, it could get nearly unpredictable or totally unpredictable what the next sample will be. So here we have two chunks of market, one that is has a lateral movement, and in this case we're reducing the price movement to just whether the price is going down or up. So a red candle will be the price going down, and the green candle will be the price going up. At a lower entropy phase is one on which whether the price is going down or up, in this case it's going down, we have a series of candles, in this case it's 4 hours candles, that are all red. So the price goes down, down, down. And if you have a string of candles, samples of the same color, you can kind of guess that the next one will probably continue to be the same color. At one point it will be not true anymore, and that's an error. But having an error in prediction while having less error, I mean having an error in prediction is something that will happen, but as long as you can predict most of what you don't predict, you can probably obtain a profit from there. In this case, instead, you can't really have a sense of what will be next. And it kind of comes to show and to explain what one may intuitively understand when is unable to actually trade and make a profit from lateral markets. It's really comes down to something that one can put down in a numerical fashion. You can take a bunch of samples and calculate the entropy, and if it is high entropy, it is indeed the harder phase in which one can attempt to make a profit. And here I would like to actually draw a parallel with image compression. On the left side, I have an image which is very high entropy. On the right side, I have an image that is very low entropy. They all have the same amount of pixels. So if one had to store each pixel, let's say 1 byte per pixel, they would take the same amount of space, whether it's in memory or on disk. But in the case of low entropy, we can guess that, for example, we can infer that if we have a white pixel anywhere here, there's a very high chance that the next one will be white as well. And so this is a more predictable signal, and it is a more compressible signal. In the case of high entropy image, it's pretty much impossible to guess what the next pixel color will be. If you have white, there's 50% chances though the next one will be white or black, and same goes with the black. So when it comes to compression algorithms, in this case, when you really have high entropy, because you can't predict anything, it means that there is no order to this image, at least no order as far as the human brain goes, or our own ability to make sense of a string of data. And so one has to store the images black, white, black, white, black, white, and store every single pixel. When it comes to image with a low entropy, we can actually establish a code by which, for example, we summarize a whole 500 white pixels as a string of 500 times, and then same goes with the black. As soon as we encounter a black pixel, we can count that we have 400 black pixels, and we can store that. It is not quite like predicting price, but it's pretty much the same concept in the sense that when you do have high entropy, it's much harder to make sense of the data, and when you have low entropy, it's much simpler to make sense of the data. And you can compress as well as you can predict. And as a matter of fact, I think one could make an exercise and take price data, for example, and again we reduce them as just going up or down. So is a single bit. If it is red, the price is going down. If it is green, the price is going up. And let's say we make a file with 0 and 1s, 0 if it is going down and 1 if it's going up. We make a big text file, and then we feed it to just any compressor, let's say a zip compressor. And if we take two chunks of the market, of the same market, but at different times, with the same amount of data, the one that will have more entropy will be harder to be compressed. So let's say we get I don't know, 1 kilobyte of data, and the market data that we compress through the zip encoder comes out as 100 byte files. And if we take one where the entropy is relatively high, it will be much higher than that. I think, I mean, this is just a different perspective on the same idea, but I think it puts some kind of a objective view on why lateral market movement is simply harder. It is because it's high entropy, it is because it's less predictable, and it is because it's less compressible, simply because it's there is less order to it. So that would be, I guess, the conclusion to this. I mean, hopefully it will make sense to some. It does make a lot of sense to me because I've been previously working with the data compression as kind of a passion of mine, and I can see the lateral how things that kind of parallel and very similar. And yeah, I think hopefully it's kind of a bit more refined explanation of just the markets are predictable or not. And again, what I'm trying to stress the fact is that there are just market phases, and some are more predictable than others. And at the statistical level, of course, if a market is always highly unpredictable, is always in a state in which the entropy is very high, then perhaps one can never make a profit. But as we know, markets do vary in different phases, and we can tell that by doing statistics the longer term. If you take multiple years of a market, there will always be phases on which there's more trend and less entropy, and there will always be phases on which the market is less trendy and there's higher entropy. So that would be my perspective to this. I don't know, hopefully it made sense. If you have any comments and questions, I'm always open to talk about this stuff. There's all links below the video. I think the best way to reach me still Discord chat. And until next time, have fun. Thanks.